This is InvestTalk. Independent thinking, shared success.
Nick from Seattle looking at RPRX.
Yeah, hey, Justin.
Hey. RPRX, do you own it or looking to buy it?
I own a small position. I added it a few weeks ago. It was starting to look attractive from like a forward PE basis, looking a little cheap. It seems like a good company. Right now, it's a small position. They announced earnings in the next couple of weeks, and the technicals are kind of improving here based on some good news recently. But I don't understand this business, and I was curious if you all have a take on, what they do and, your look on the stock. So.
Well, this is the name that's been in a strong downtrend, but looks like it just reversed. I typically like those names, that are starting a new uptrend after a long period of bearish sentiment that really has overtaken the name since 2021 when it peaked out around $52 per share, and its recent low was down around $25 per share. Now we're at 31 and change. Now what this does is the largest buyer of biopharmaceutical royalties. Okay, and so it has a portfolio of royalties that allows it payments for as a percentage of sales. So it has more than 35 commercial products on the market, including products that AbbVie, Johnson & Johnson sell. A bunch of Biogen, IDEC, Vertex, and there's 10 in development stage. And so what it looks like this company does is it picks certain biotech companies and products that are going through trials, and they help finance those to get to market. And so they're making a bet that these will get to market, and then they own a royalty on them, and they just collect a stream of income. And typically that's a good business. It kind of reminds me of the gold and silver streaming companies. There's a couple big ones out there. There's a couple that we own for our clients we own for a long time, and they tend to be very good businesses because it's low cost of low capex, high capex because they're investing in this, but low ongoing working capital. There we go. That's what I meant. In the business, it's just okay. If you bet on the right ones, then you can get that nice stream of capital. Now, the question here is, patent cliffs makes it complex, right? Because at some point, these drugs come off patent and the price comes down dramatically and the royalties are worth a lot less. And then you have pressure, especially here in the United States. Does RFK get confirmed? Is there some pressure there on drug prices that are vastly different here than many parts of the world? So is there some pressure there? And I think that's the biggest worry here. Now, I have to dig into why this recently popped over the past few weeks. Do you have any insight on that?
Yeah, they had an announcement around a share buyback program and like a $1 billion acquisition that I guess the market liked. Mm-hmm.
I think that it's still risky. Yeah, because of that potential pressure downward on drug prices. Now, analysts are upgrading earnings for this year and next year. That's a positive. But I would have to dig into the details here about all the royalties, what type of patent cliffs there are, and then you just have that overarching risk that there could be pressure to lower these drug prices or stop allowing these companies to raise drug prices, especially if they're still drastically different than they're selling in the rest of the world. So the technicals are fine. I don't really see any issue on that front. It is cheap. You're talking about a $31 stock making $4 per share this year, but it does have a good amount of debt, about $7 billion in net debt in its balance sheet on a $14 billion market cap. That's not a small amount. So there are some risks here. I think it's a decent risk versus reward, but I don't love it mainly because of that overarching worry that drug prices are going to be pushed lower in this new administration. So, choose carefully here. Thanks for the call. Now, have you been telling your friends that our audio podcast is available in video form, which you can find over on our YouTube channel, and we get questions submitted over there. So let's check out one of those now. Shawnee Boy 111 says, first off, guys, love the podcast. Really appreciate the videos. It's great to not only hear, but to see the why behind your thoughts. Keep up the great work. I did want to get your thoughts, insights on UGI. I currently own a small position. I'm considering selling some of the position to lock in profits and go to house money due to technicals. I can see the possible double top in the technicals in question. The fundamentals going forward. Any insights from your end would be greatly appreciated. Well, thank you for the kind words. And let's take a look at UGI is the symbol. And this is UGI. It's a holding company with interest in propane and butane distribution, natural gas, and electric distribution services as well. And the trend here is certainly up. This is a name kind of like that one we talked about earlier was in a long downtrend. This one peaked out at $48 back in 2021. Hit a recent low around $20. Now we're all the way back up to $30. So nice rally. We're in an uptrend. And I generally like this business. The biggest issue, if I remember correctly, let me pull up the data here, is its debt. Yeah, it does have a good amount of debt on its balance sheet. Free cash flow is at nearly $400 million and has recovered from going negative in 2023. I think that was the issue, why I was in a downtrend. When a company has a lot of debt and then free cash flow goes negative, the market starts to worry. Now, the dividend yield of nearly 5%, it's pushing up against its payout ratio and cash dividend payout ratio. I would certainly worry that is not going to be sustained. So I think this is a good place to trim on UGI. Explore additional content and tools by heading over to InvestTalk.com.
Guys, Mark from San Diego, love your show. Asking about Oracle, ORCL. They seem to be at the bottom of the Magnificent Seven. People are just not interested in them right now, but they seem to be got some stuff happening. So I was wondering what your viewpoint is, and if you were to buy, what price level you would be looking at. Thanks. I'll listen for it on the show.
All right, looking at Oracle, and this has been a bit of a volatile name as of late. It peaked back in early December, around $200 per share. And it's been in a choppy downtrend ever since. And now we're hanging right around 170 or so, 170 and change today. I don't like the technicals, and you're looking at a good business. I have no problem with the business. Let me start with that. I like the business. Would I be buying it now after this recent volatility? Probably not. And uncertainty around AI. They provide databases, enterprise resource planning, etc. And once again, a very good business. If you look at its return on equity, 128%, return on invested capital, 12%. That's probably more realistic. And they have a solid balance sheet compared to their market cap of nearly $500 billion. Now, free cash flow is about $9 billion. So you're talking about a free cash flow yield only about 2%. I don't love that. And if you're looking at enterprise value to EBIT, it's about 33 times, and that is near its all-time high. So not a name that I'd be jumping on right now. Certainly a name that is a good business. Not poo-pooing the business. It's just I don't like the recent trends, the overhang with AI, as well as that recent the recent earnings revisions downward as well for this year and next year. Those are trending lower. So I'm going to pass on Oracle, but certainly remains on the watch list. Now, on Fridays, we generally take a minute to run down some key benchmark numbers. So let's do that right now. The 2-year Treasury yield was at 4.2%, down from 4.27% at the close last week. Now, the 10-year yield was at 4.52%, down as well, even more from the 4.62% last week. So you're talking about 10 basis point drop in the 10-year overall. Gold prices up to $28.09 an ounce, right off its all-time high. Last week it closed at $27.74. So once again, as I said at the top of the show, gold remains in a nice uptrend. Silver as well, up to $31.46 per ounce. Last week it was at $30.68 also showing some good strength there. Oil was at $72.82, down about $1.74 from last week. I do think oil generally will trend higher, probably more into the high 70s throughout the year, but a bit of a dip so far this week. The average gallon of gas cost $3.11, 2 cents less than it was last week, and still way down from where it was a couple of years ago at $3.57. And here in California, average gallon of gas is $4.45 per gallon, a 1 cent increase over last week. So the rest of the country is seeing a bit of a drop. We're seeing an increase. Now, for comparison, in Indiana, the gas last week averaged $2.96 per gallon. So that was a rundown of the major data points as we close out the final week of this month. Now let's touch a bit on banking. And we had the banking crisis back in 2023. That was the Silicon Valley banking crisis. And we're now 2 years on from that, but banks are still struggling. And now it's not about solvency. It's the other side, which is growth. And it's not really the mega banks. The big banks have investment banking arms that continue to do well with mergers and acquisitions, raising capital, whether that's debt or equity, whatever that is, they're doing well. But those mid-sized banks, regional banks, they are the ones that are struggling the most. And even though the KBW NASDAQ Banking Index with both large and regional banks are doing well, up about 10% so far this year, outperforming the 3% gain on the S&P as a whole. But if you look at the financial results, you see something different. One of the large regional banks, PNC, had earnings recently, and there's no loan growth there for the first quarter of 2025. And so what they are citing is a hazy outlook on tariffs, taxes, and the federal budget. And even though they're gaining clients, they're getting more people to use them, their customers, the businesses that use PNC, are not tapping the available credit lines. And so the question here, is this some sort of underlying economic weakness, or is the financial system evolving? And I'm going to say it's probably more the latter. Now, across all commercial banks, loans grew about 2.7% from the end of 2023 to the end of last year. Pretty decent, a little faster than the previous year, which is at 2.3%. But it's still the lowest loan growth since the financial crisis. And really what they're struggling with are C&I loans and commercial real estate loans. So C&I loans are commercial and industrial lending. In 2024, banks' C&I loan growth was just 1%, up 1% from 2023. And loan growth at the end of the fourth quarter from a year earlier was under 2% on average across 34 large global, national, and regional U.S. banks. And a lot of those banks saw loan growth declines. Wells Fargo, PNC, Citizens Financial, KeyCorp, Regions Financial, and Comerica, all seeing negative loan growth overall. One of the big headwinds here is actually, like I said, commercial real estate. Now, what's happening is the value of that commercial real estate is dropping. And so a lot of the owners of these buildings have to cough up more equity, put money back into the loan, and the overall loan falls because the collateral is worth less. And so a lot of these mid-sized banks, this is where a lot of their lending goes. They don't have other types of lending connected to consumers, for example. A lot of that is done by JP Morgan, Citigroup, Capital One, Synchrony Financial. Those are the ones that are big in credit card lending. Commercial real estate loan book grew only 1.3% in 2024. And then there's the other side, which is where companies are going to get capital to borrow. and they have more choices, mainly in private credit. And this is, I see this, I know business owners that are doing this. They're not going to the bank. They're going into the private credit market because there's a lot of money there. The Merrills and Morgans of the world have pitched these private credit funds to a lot of wealthy individuals, and they bought them, promising big yields. And so there's a lot of money there, and those funds are able and willing to take more risk. Why? Because they don't have to market the market. They can kind of say what these loans are worth. And so that's where a lot of capital is coming from. And as more and more companies borrow in that way, these regional banks are going to struggle with loan growth. In the middle of last year, the share of corporate debt that was in the form of non-mortgage bank loans, so not loans on sort of property or anything like that, your traditional lending to corporations, was only 9%, was coming from banks, large banks, commercial banks. In the 90s, it was 20%. That's where 20% of that borrowing came from. So it's down over 50% from where it was in the 90s. That just shows you the growth of other types of forms of capital. And so when you're looking at regional banks, understand that there's not a lot of ways out of this, because they don't. Where do they go from here? How do they spark lending growth? They're not big in credit cards. The areas that they are big in are struggling for the most part. They're having to compete with other avenues for capital. And so it's hard to see a path forward for these mid-size banks. Let's keep things moving forward and play another question from the InvestTalk voice bank. You know the number, it's 888-99-CHART.
Hey, Justin and Luke. Jeremy from New Jersey here, longtime listener. I just wanted to say real quick, you guys actually inspired me to become a financial advisor, which is awesome, and I love it. So just wanted to get your insights on a ticker EME, MCore Group. It got beaten up on Monday with the DeepSeek sell-off, and it looks like an interesting company, $20 billion market cap, trading at 18 times next year's earnings, really low price-to-sales ratio with really good revenue growth. Margins are moving in the right direction. Share count is going down. They're doing buybacks. It looks really good here. I kind of want to pile money into it. So I just want to hear your thoughts.
All right, looking at MCore Group, what do? Is they provide mechanical and electrical construction services for commercial, industrial, and utilities. And they've done very well as the build out of these AI centers have ramped up. And earnings have ramped up accordingly. $6.40 they earned in 2020. And then this year, full year 2024, once they release Q4 earnings, will be nearly $21 per share. This year, it's supposed to be $22.78 per share. But as with this DeepSeek topic, this is kind of roiling anything that was getting those AI tailwinds. And MCore is certainly one of those. And the fact that NVIDIA hasn't really gotten off the mat, they go and take a look at that chart. NVIDIA's closed today at its lowest close since Monday. So it bounced on Tuesday. It was a bit lower on Wednesday, slightly higher on Thursday, and then decidedly lower today. And once again, this is the second lowest close of the week. And you look at MCore, and it's a bit stronger, but similar pattern. This is what we call a bear flag. So it reminds me a lot, the whole AI space right now, reminds me a lot of post-COVID, and where money was just flowing into anything that was work from home related. And I just look at Zoom was kind of the poster child, right? Everybody had a Zoom account. Everyone was signing up for Zoom because we were all working remotely. And what did Zoom do? It went from $50 all the way to nearly 600 in just the span of, what was this? A year? Yeah, about a year. And then what did it do? fell all the way to $50. Full round trip. And it was the market just buying in, or the average person buying into the narrative. And not looking at, what is the reality is that, these things kind of ebb and flow and there's long-term trends, but they typically aren't as strong as the growth is out the gate. That growth slows because companies start to realize maybe they overproduce, they invested too much in capacity, they slow down. Some of the capacity was built out correctly and worthwhile, than others not so much. And I think you're going to start to enter that period. And from a technical perspective, this just broke negatively, just like NVIDIA broke negatively. Now, it's 1 week. It could be a flash in the pan and we have a big reversal next week and then things continue on their merry way in the same ways they were before. My gut says that's not the case. My gut says that this DeepSeek news was a shot across the bow of all those companies that were spending tens of billions of dollars and combined, hundreds of billions of dollars to build that capacity and compute power. And it probably wasn't that necessary. There are other ways to do this more efficiently and more effectively. And so companies like MCore, does it trend back to, probably doesn't trend back to $6 per share, but even if it goes back to $15, $10 per share, which is still drastically higher than it earned just a few years ago, that means a much sharper drop in the price than you've seen recently. So while I understand the story, and if you're looking just on what's happened over the past couple of years, yeah, it looks modestly cheap. But I think there's a lot of risk that this DeepSeek question is game-changing for the industry as a whole. And that's the call you have to make here. That's what investing is, right? My view is wait. My view is keep it on your watch list. At some point, just like Zoom, we picked up Zoom for clients just a handful of months ago. Because it was cheap again. It was worthwhile. It was worth it. And MCore and a lot of these AI names will be worth it during that next down cycle. But my gut here and the data is starting to say we're near the peak in a lot of these names, not the start of anything. Not the start of anything positive, at least.
Thank you for watching.
If you liked what you saw, make sure to give us a like and subscribe for more informative content. Let's go take a question from our YouTube channel. Jay Soso says, what are your thoughts on GHM for a long-term equity? What would be a great entry point if it's a good long-term position? Looking at GHM, this is a small name, $500 million market cap. So the first thing you have to say with a small, this is a borderline micro cap name, is to say anything long-term hold. It's hard to say because typically these names have a spotty history of profitability and tends to be up and down. Here's what you see here. In 2022, they actually lost money after making 65 cents back in 2019 pre-pandemic. And then in 2024, 63 cents in earnings. And this year is supposed to be 89 cents in earnings and then $1.18 next year. So certainly some nice trends here, no dividend, and they have no long-term debt. So I love the balance sheet. Now, what do they do? What they do is the broader question. This is Graham Corporation. They design and manufacture mission-critical fluid power, heat transfer, and vacuum technology for the defense, space, energy, and process industry. So they're an industrial name. I like the space as a whole. I like what they do. It services sells parts for its equipment as well. So they have a service business. That's very good. And they're in the petrochemical business. So generally, I like this. I like what they're doing here. I like the trend in the stock. I like that balance sheet. Return equity 7%. Not amazing, but certainly on the rise. And that's my first question is, what's happening here? This has been a company with a spotty history. What has changed over the past, call it 18 months? That has changed the trajectory of sales, of earnings, and overall profitability. Are they just able to up their margins? Is there something, they make an acquisition that kind of transformed their business? What was it? If I have confidence in that change, that is sustainable, I definitely think it's a long-term hold. Because once again, I like this area, I like the balance sheet, and I like the profitability. Thanks for the call. Now, lastly, let's talk about natural gas. And U.S. stockpiles have dropped to 4.14% lower than normal for the first time this year. So typically there's this big curve in natural gas, in stockpiles. Okay. And it has to do with the time of year. Right now it's cold. People are using a lot of natural gas for heat in their homes. And the colder it is, the more natural gas they tend to use. And we know since the shale revolution that there's been a glut of natural gas out there, tons of it. And that has pushed prices lower. But recently, prices are on the rise. You've had a bit of setback, real short term, but generally prices are up. And what you're seeing right now in the numbers is that rally in natural gas is justifiable. And a lot of this has to do with increasing demand for electricity across the board, talking about AI generation, just cloud computing, but also think of electrifying our fleet of vehicles, with some people buying electric cars. Now, that electric car growth is slower than everyone expected, but it's still there. And so just general increase in demand for electricity is helping sop up a lot of that excess inventory of natural gas that's been there for a long time. So you're starting to see a shift in balance of natural gas. You also have exports of natural gas to Europe, and obviously Trump has talked about doing that, right? Getting more business for America, exporting more of that, and that will increase the price of natural gas here overall. Now, that's good for natural gas companies, obviously, but the big question is weather. And the Arctic right now is unusually cold, and usually that feeds into a longer winter. And I think that's underappreciated in the way the market is looking at natural gas futures. And so I expect natural gas to generally remain strong throughout this year, and the numbers continue to back that up. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And if you need help better understanding your broader financial situation and your risk level in your portfolio, whether the amount of the type of risk you're taking makes sense for you, does it align with the current market trends? Well, I encourage you to head over to investtalk.com, click on the portfolio review button, and schedule a time with me. Independent thinking, shared success. This is InvestTalk. Have a wonderful weekend.